Welcome to Major Money Matters. My name is Mage. I'm a mortgage broker powered by Edge Home Finance. And today we're going to talk about the reasons why we're seeing a big credit squeeze. And if you're a realtor or if you're a buyer, we're going to talk some things about why we're seeing people not qualify or qualify for less than normally they would. And this is normally going to affect first-time home buyers or something like that, or people that are in the middle of a huge transition of life in one of these situations. But we're going to talk about four big things we're seeing with the credit squeeze and why it's harder for people to qualify. Number one is obvious. Look, there are higher interest rates right now. Higher interest rates mean higher monthly payments, and there's higher insurance costs, higher housing insurance costs. It is just a challenge right now to get homeowners insurance lower, especially places like Florida and Texas, where you're seeing storms hit, and now insurance companies are now have to charge higher premiums in order for them to cover the losses that they've had to pay out in homeowners insurance. Interest rates are higher, monthly payments are higher. So you're starting to see people not qualify or qualify for significantly less. And sometimes people come to me and say, hey, I want to do a down payment assistance program or something like that. Those down payment assistance programs also carry even higher interest rates. So there are only certain people that can fit into those things or fit into those programs. And it is very challenging right now. So higher interest rates is going to be number one. Number two is inflation and the effects of inflation. All right. So when there is inflation, the last people to actually adjust is actually consumers. So the inflation rate has gone up and come down. Inflation is not increasing right now. However, over the past year, when inflation went up, buyers or consumers do not adjust their lifestyles to that stuff. Consumers are usually the last people to adjust to inflationary things going on. They just start doing things like put stuff on credit cards, put stuff on lines of credit, and take out more debt and stuff like that. Even when the price of used cars was higher, people were still buying used cars. They were just financing them for longer periods of time, or at higher amounts. Well, as a lender and as a mortgage professional, I'm seeing the effects of that, because every single $100 of debt means you qualify for $20,000 less when you're doing a pre-approval or buying a home. So every single $100 robs you of $20,000 of purchasing power. So now we're starting to see the effects of that, because people's debt is higher because they did not adjust when inflation was high, and they just put stuff on credit cards, whether it was grocery or cars or whatever. They just charged more. They did not adjust. And now we're having a huge problem with people qualifying because they did not adjust to what was going on in the world. Number three is divorce. Okay, listen, COVID has had a profound effect on families and stuff like that. You said you wanted more time with your spouse. COVID taught us that was a lie. You do not want more time with your spouse, and more people are getting divorced. And as they get divorced, along with divorce, if there are children involved, there is child support payments involved. And those child support payments are causing some people not to qualify to buy a home, or to qualify to buy a home that's significantly less, because they have these higher child support payments because of COVID and the effects of COVID, and their child support payments. So they're actually qualifying for a lot less. So that is something that is absolutely derailing people's pre-approval. When they have child support, we must count for that child support payment, okay? That child support payment has to be counted as technically debt or DTI. Now, what if you're on the other side? There are some situations where if you're receiving child support, that can be counted as additional income. That is possible to count that as part of your pre-approval or your purchasing power or something like that. There are guidelines and qualifications for that. But child support is also having effect on pre-approvals and purchasing power. Last but certainly not least, look, the DTI situation. DTI, if you're buying your house, is your debt to income ratio. All loans have a DTI parameter, with the exception of VA loans. VA loans have a residual income parameter, but DTI, or debt to income ratio, is going to affect your pre-approval amount I took a visit up to one of the lenders that I work a lot with, United Wholesale Mortgage, and I was having a meeting with a couple of the underwriters up there. And I said, hey, tell me, I can tell you what I need, but tell me what you are seeing from your perspective. And they said, Major, you got to understand that everything is so close right now, because there are like nobody that they're doing loans for where the DTI is like 20, 30. Oh, they said nobody, that's an exaggeration, but very few people have a DTI like 20, 30% when they're purchasing a home. They're at the 41, 42, 43%. And on a conventional loan, your DTI cannot be over 50%. So if you have one little hiccup, one debt that comes up, one thing that can't be discounted, a higher than expected property tax or a higher than expected homeowner's insurance that goes into the DTI, you have a problem where that person doesn't qualify. So you're having this huge DTI strain on people where it's very challenging for people to qualify for homes. And sometimes you're having situations where people are falling out of escrow because you have one little number that changes, $100 here, $200 here, and you have a huge DTI issue. So if you're a realtor, you should be asking these questions like, hey, where are we on DTI? Do we have any play in it? Are we low? Are we high? What are your expectations? Ask those questions to the lender, so you have an idea of how the escrow is going to play out and what could frankly potentially go wrong. Ideally, I mean, sometimes you can ask the lender to get a pre-underwritten approval before you fully accept the offer or something like that. So understand that these 4 factors are absolutely affecting people right now. We're in the middle of a credit crunch like no other. Lenders are making it hard to lend, okay, just because of certain parameters that are going on right now in the world, and you're seeing it affect your buyers. So we're in the middle of this. When does this end? I don't know. Hopefully when interest rates come back down, when people start getting wiser about not putting stuff on debt and stuff like that and paying off their debts, paying down their debts so that they qualify for more, we could do a lot better. But it's just the state that we're in right now, and it's getting harder and harder for your lenders to qualify your buyers to get into a home. Hopefully you guys understand the state of the market right now and the state of our economy and the state of the lending world. We'll see you next time on Major Money Matters.